In this AMT Insight, I'll be discussing the drivers behind the recent pullback in base metals prices from the extremes of early March. So to recap the price developments we've seen over the last month or so, we initially saw Russia's invasion of Ukraine and subsequent Western sanctions very much acting as the catalyst for rampant commodity price gains in late February and early March. You saw energy markets leading the commodity sector higher, also precious metals and wheat saw aggressive rises, and all 6 of the LME based metals saw very strong gains, all of them except lead surged to record all-time highs. So most of those commodities now have since pared those gains back. They've basically lost most of the gains they've made since the start of the war. On the metal side, that's with the exception of zinc and nickel. Now, what's really been driving that? Well, one of the clear catalysts of the metals price weakness, at least, has been LME liquidity issues and market disorder, very much triggered by the nickel's unprecedented move higher in early March and subsequent trading halt by the LME. Really what caused that spiral higher was this spiral of short covering and price hikes that was very much self-reinforcing. And that occurred as short position holders, including top China producer Tsingshan, very much struggled to meet escalating margin call requirements. This scramble for liquidity has very much affected other metals. You've seen nearby spreads pushed into contango for most of the complex, and that's really amid a reluctance to tie up capital financing metal. So you've seen a lot of lending and not much borrowing. Now, the suspension of the LME nickel contract itself and the reversal of trades that were made on the 8th of March, I think has very much damaged confidence in the LME amongst part of the fund community in particular. That's incentivised outflows. I think generally investors are stepping back. They really don't want to engage with the market unless they can be sure that market conditions have normalised, and some of them have been badly burnt by that reversal of trades and probably won't be returning for a long time, indeed at all. Now, the return of the negative roll yield because of that contango in the near part of the curve for most of the base metals is perhaps something else as well. It's an additional cost for long position holders now to roll positions. That's another reason perhaps why some of them have thrown in the towel. Now, another key factor driving markets lower has been the reduction in risk from the Russian war in terms of the impact on metal and energy exports. So initially there was this big threat that you'd see disruption to that trade in metal and energy because of Western sanctions, and that was a key driver of the price gains higher. I think the markets are very much pricing in a worst case scenario there in terms of disruption to trade. That's not something that's yet been realised. In reality, there hasn't been any evidence really of very much significant restrictions or de facto embargoes on metal and energy flows, and those remain largely exempt from sanctions anyway. I think really what you have seen that perhaps has been the limit of the disruption has been that consumers themselves have been taking steps where possible to secure alternative suppliers to Russia, both for practical and reputational reasons. I think as time goes on, you've seen that the price of commodities has pulled back because there's been a decaying risk premium for in terms of the supply risk for Russian exports, and that's also been helped by the signs of growing willingness between Russia and Ukraine to negotiate an end to hostilities. However, you could still see an escalation of military activity, a breakdown in those trade talks, and perhaps stricter sanctions as a response that could all increase that threat of disruption to trade in key goods. Now, another key factor, something that's really taken off in the last week or two, has been a resurgence in COVID cases in China in particular. So China's maintained its zero COVID approach, and it's continued to take that approach as it deals with this worst outbreak of cases in the last 2 years. So reported infections have surged in over a dozen provinces in China. You've had lockdowns or very strict restrictions in key industrial hubs like Shenzhen, Changchun and Shanghai, although some of those are more recently been understood to be easing. Now, the risk here is that metals prices will be impacted because the key areas that have been impacted by these lockdowns and restrictions are metal consumption areas. I think there's still the potential for further disruption as well to port activities, and that could extend global supply chain woes. But I think the overall reaction to this surge in cases has been it's going to be something that weighs on growth, weighs on Chinese demand and global demand more broadly, and also adds to inflationary pressures. Now, inflationary pressures themselves are something that are also a key theme in the market and remain to be. If you look at commodities, utilities and inflation hedging asset, that's really been something that supported metals prices over the last year. So investors have been increasing their allocation to commodities and to metals. But that was really taking place very much in a scenario where we had this reflation trade really defining the whole of last year. So that's very much been stimulus-driven, demand-driven increase in inflation to more normal levels and reducing really deflation risks. Whereas now we're seeing excessive inflation, something that's very much likely to weigh on economic growth and defined very much as stagflation, high inflation, low growth, and that's something that's really a risk for people and for markets in 2022. You can observe that very much in recent faltering equity market valuations. I think in terms of how it impacts industrial metals, I think a stagflation environment is still an inflation environment, so it's potentially still supportive for metals. But compared to reflation, you're seeing this underlying physical market vulnerability now to demand shocks. And part of that is really that leading central banks are very much committed to tempering the high inflation through tighter monetary policy. And the effect of that is going to be to reduce aggregate demand, trying to bring it more in line with supply. And overall, that's going to be destructive or potentially destructive to economic growth prospects and indeed to metal demand prospects as well, or at least that's the risk. So overall, I think we can draw the conclusion that prices have clearly moved too far and too fast in terms of their moves late last month and early this month, really on the back of LME market dysfunction, liquidity issues, and panic's initial pricing of Russia supply risks. I think now you're seeing that LME liquidity issues, the war in Ukraine and Chinese lockdowns are all things that are really going to continue to drive prices and volatility in the weeks ahead, perhaps more than underlying fundamentals in the base metal markets. Although those fundamentals themselves for base metals still remain largely positive. You still have very tight markets with low inventories, metal that's not in the right place globally for where the consumption is, and that's something that should provide underlying support to these markets. However, it's very much very difficult to see the near-term solution to this fundamental tightness in metal markets. I think ultimately the solution is either going to have to be demand destruction at higher metals prices down the line, or are we going to see this global demand shock triggered by stronger energy prices and tighter monetary policy? But in the short term, very much a lot of uncertainty and perhaps the market moving in abnormal ways, not perhaps defined by the fundamentals. Now, that's the view on where prices are at the moment and where they might be going. If you continue to be interested in these insights that we're putting out, again, I would very much encourage you to follow AMT on LinkedIn, and the details are above me there. Thank you very much for listening.